the lumber futures from the free seats. As always, the handsome Greg Kuda is with us. And we have a special guest today, Andy Hecht, who we will introduce a little more thoroughly in a little bit.
I wish I had Greg's hair.
Right? Uh, well, I'm not sure how long Greg's going to have it. He's got a couple of young kids, so that
I
may
got
change.
everything and anything in between. So I got a 17-year-old and a 5-year-old. So
That's
I'm
awesome.
burning at both ends here.
Enjoy them. We just had our first pair of grandchildren, so
congrats.
Thank you.
Wow, impressive. All right, I'm just trying to get pulled up on see how many people we've got coming through the door through my phone on Materials Exchange. All right, we are live. Perfect. Well, another exciting day in Lumberland. We're sitting limit up right now. 40 contracts bid in the March contract. We just traded off a limit traded the pool that was in May. But the name of the game for lumber for the last 12 months has been volatility, and so 2022 is not disappointing us. Right out of the gates, we're seeing the volatility come right back. So, Greg, why don't we get going here and let's go over the normal indicators, things the data that we look at every week.
Great. Happy New Year to everybody, and let's get started here. I'm going to share screens here, Mike.
Absolutely.
Let's see here. Let's see. Okay. Can you see that?
There it is. Now I can. Perfect. All right, lumber futures.
All right, let's get started here. So it's just a January daily, and it just gives a feel for where we're at. We made lows back on the 22nd of December at 920, made the highs of 1172 on 1230, and today we're 1030. Actually, we're 10. I'm sorry. This is a typo. We're not 1030. We're 1130. My mistake here, but we're kind of just floating in between. The one thing I'll point out from a technical formation, you have a triangle formation forming here. You've got a bull flag, so the indications are that we want to go back and retest the highs. That this little lull, this little kind of mid-holiday lull, was a buying opportunity, and we're more than likely to go retest the highs here. If we jump S&P, I know we talked about this last week. Some of the correlation between the other markets, like the equities and energies and some of the other commodities. S&P is basically at all-time highs, along with the other indices. Crude oil is getting ready to potentially break out here. So life is good again, regardless of what's going on with the variant in the country. The markets seem to want to ignore it and just fixate on what lies ahead, not what lies now, but what lies ahead. The other thing, and I'd love to get Andy's take on this. I pulled up a 6-month return just to compare lumber to some of the other commodities. So here's a 6-month ranking. Lumber is number 3, up 48% over the last 6 months. And if you jump to a 52-week comparison, lumber is number 2 behind oats. And you can see how lumber compares on a 52-week basis to the S&P. S&P is up 31%. And even crude oil here, crude oil is up 60%. Lumber's up a whopping 107%.
So, Greg, it's very interesting. If you keep that chart up for a minute, if you look at all these leaders, they are all either foods or industrial commodities. So, the Fed has abandoned its characterization of inflation as transitory. Took them a while, but they abandoned it in December. But very interesting stat that I want to bring up here is that, I do quarterly reports and annual reports and commodities, and I look at, I look at about 29 different commodities and that trade on the U.S. and the U.K. exchanges. I do not include lumber in that or oats in that because I look at liquidity. You know, I want to look at the most liquid markets. And very interesting observation. In 2021, the sector was up 26.79%. Those are the 29 liquid commodities that I put in my composite. Ironically, the S&P 500 was up 26.89%, a tenth of a percent difference. And what that's telling me is that inflation is really affecting all asset prices. It's real estate, it's commodities, it's cryptocurrencies, it's stocks, you know, and it's the erosion of the value of the dollar is not readily apparent when you look at the dollar index or you look at currency markets, because currency markets are a mirage. They measure one currency against another currency. But when you measure all currencies against raw materials and other asset prices, you know, a very interesting picture emerges.
Yeah, no, I think that's a great point. I think that's a great point that, you know, the Fed came out and said inflation, in fact, is not transitory. And I think the day of reckoning as far as interest rates and how markets will react to it is going to be sooner rather than later. And
that's true. But remember this: we're in a midterm election year, and you know, jacking rates up to crash the stock market is not kind of politically appetizing to the party to either party. And moreover, every 25% basis point hike in the Fed funds rate is going to cost an additional $75 billion in annual debt servicing on a $30 trillion national debt. So, you know, and also the variance, you know, there's a lot of outs for the Fed. So, you know, while inflation continues to go up, and CPI numbers, I think CPI is also a mirage because I think inflation's much higher than, you know, 6% right now. Ask a farmer who has to buy equipment, or, you know, look at the price of oil up 55% in a year, and look at the price of lumber, you know, up almost 84% in just the fourth quarter. You know, prices are going up much faster than CPI tells us. The Fed is going to have to act, but they're going to act prudently because, you know, there are other factors that are kind of scary for the central bank here.
Yeah, no, I think that's a great point, and I don't disagree. I think when we kind of boil this back to our industry, our sector, when you look at kind of the 10-year through the 30-year and every basis, quarter of a basis point increase in mortgage rates, interest rates, and then you look at, you know, okay, inflation is very real when it comes to price appreciation, land price appreciation, existing and new home price appreciation. With each kind of measured increase in those variables, you take out lower and lower tranches of first-time buyer home ownership. Wage inflation is not measuring price inflation when it comes to housing. So, you know, I think you see this with our housing starts, where you have this reversion back to multifamily away from single family. The single family component has been the leader for housing over the last 18 months. Now you're seeing this shift back to multifamily. What's the reason? Well, people can't afford an entry-level home. So with each increase in these inflationary metrics, you take out that entry-level home ownership and you push people, okay, I don't want to rent. Okay, instead of buying a house, I'm going to have to buy a condominium. I'm going to have to buy you know, some kind of multifamily is going to be my way to home ownership. And you've seen builders gradually shift back to the multifamily component away from the single family. And that's, you know, the direct result of higher interest rates and higher inflation when it comes to land and home ownership, you know, and
Right.
that's unfortunately where we're at.
You have two dynamics operating here. I mean, and I agree with you 100% about that, no question about it. But you also have a migration going on from states like New York, Illinois, California, high tax states, to Texas, to Florida, to Nevada, where I am right now, where I live. We see my neighborhood is when I first came out to Vegas in the 1980s, my area was just desert. And now, the desert is slowly crawling up to the Red Rock Mountains here, and the building is unbelievable. And we see a huge influx of people coming from California to take advantage of no tax. And the building is out of control. And a lot of the builders, I know a lot of people who work and who are in the building and construction business here. A lot of the big, they work for companies like Toll Brothers and Lennar and the big home builders. And they're having big problems accessing, framing wood for new houses. And, they're paying up these days, big time. And even when the price came down, they were paying big premiums, which led me to believe that, the liquidity, as we said, in the pregame, when we were just chatting before we came on the air, the lack of liquidity in the lumber market exacerbates the price moves. So, when lumber was coming down from 1,700 in May down to 488 per thousand board feet in August, bids disappeared in the market for that time, and it probably goes a lot lower than rational levels, and it goes a lot higher than logical levels when it rallies, because offers disappear in the futures market. And that's what happens when there's lack of liquidity and small open interest in volume in a market. But the bottom line is that the demand for lumber remains very, very strong, because new home demand is strong, and the prospects for higher interest rates in 2022 could lead, and lumber's telling us it's going to lead to a spring boom, because people are going to want to buy houses before those interest rates start jacking up, in 2023, 2024, when we really feel the bite of this inflationary spiral.
Yeah.
I think what's interesting about the inflation conversation, and maybe we'll wrap it up with this and move back to talking about what's happening in the lumber market. Inflation is an increase in asset prices. For you to take advantage of that, you have to have assets. So this is where the dichotomy of homeowners or home buyers comes into play, in that if you have assets, you generally have more wealth. You're going to buy a bigger home, a non-starter home. No assets, you're going to end up needing to buy an apartment or rent an apartment, buy a condo, something along that line. And what I'm seeing, much to what Greg just said, is we see more multifamily builds going on, because there is cash flow, there's cash out there that needs to go to work. And one way that people feel they can put it to work is in a house, especially if they feel that assets are going to increase.
Absolutely. And hey, but let's also not forget about another very big factor that's, underpinning the lumber market, is that, we are going to spend trillions to rebuild infrastructure, and lumber, that is a deal that passed in Washington, and lumber is a critical construction material. And, I think that is affecting the price too. Government's going to wind up paying up for lumber over the coming years.
Yeah, absolutely. All right, Greg, let's touch on a couple more of the key data points we're looking at usually.
Yeah, so I just wanted to update. This is the January basis. So again, for people listening, cash minus futures. So a week ago, January, our cash was trading at a $105 discount. Futures were trading at a $105 premium. Now that we're in spot month, we're starting to see the convergence. We'll continue to see the convergence. And I did two charts here, Mike. This shows cash, and I picked 1070 because West Fraser came on out of the south today at 1070 on Western SPF 2x4s. And then, okay, so January high, we're a little bit lower, but the high was somewhere in this 1140 area today, so 69. And then you talk to people in the industry and they're like, wait a second, we can't buy that 1070 West Fraser wood. Cash is more realistically an 1100. So if you use an 1100 cash, this basis converges into $39. But historically speaking, we're still carrying some kind of premium in futures relative to cash versus where we should be. We should be even money to 20 under. Cash or future should be at a discount to physical cash historically. We still have a premium. And if you look at the, here's kind of a long-term chart that shows we had the convergence 3 weeks ago, back out. And so we're somewhere in this, depending on how you want to look at, somewhere in this $70 to $30 premium in futures or discount in cash. And if I go to March, here's the March chart. I'll run through March basis. Again, last week we were $105 premium, or cash was the $105 discount to March. If you want to look at cash today at 1070, we're into 74. If you want to look at cash at 1100, we're into 44. So again, you're still maintaining some kind of historical high premium level in futures relative to cash. And then
Can I
yes.
interject and ask a question here?
Yep.
You guys have a lot more experience in kind of the physical lumber business than I do as kind of an outsider who watches it, who's been watching it for 40 years. But one of the things that strikes me, and I'd like to have your comment on it, is that, this year and last year, lumber prices, in the late fall, early winter months had been very bullish price action. And that's kind of a departure from what I've seen in past years, when construction tends to peter off, during the winter months. Do you, what do you attribute that to?
Well, something you said before, migration. You know, July is the winter of Phoenix, meaning it's hard to build in Phoenix in July. It's just too damn hot, right? So as the population moves further south, I think the cyclical curve is flattening out.
Great point. Great point. Okay.
I think the other thing, when you look at last year, Andy, I think prices peaked out in the $1,000 area last September. So this would have been September of 2020. And the expectation is you were going to have a much more severe correction in pricing. So typically lumber bottoms into the 41st, 42nd week of the year, which is the middle of October through US Thanksgiving. And that's typically when people will build out their inventories in anticipation of their Q1 needs. And last year, lumber bottomed out substantially higher than the historical price averages. So you never had that reversion back to historical mean type pricing. So people never got ahead of the curve to build out their inventories. They were in chase mode last year. And even this year, I think when you compare this year versus last year, it's an apples to oranges comparison, where last year was more demand driven. There was just all this organic demand that was created because of COVID, whether it was rehab renovation or new home construction. This year, you've had all these supply constraint issues where we had forest fires in BC. And then 6 weeks later, you were dealing with torrential floods, landslides. So you have all these disruptions this year to supply that have influenced more so than demand. I think demand is organically there, but it's not there like it was a year ago. This year is more about supply constraint type issues driving prices higher than actual demand.
And Greg, there's an invisible hand out there that's driving the flattening curve of the seasonality, and it's offsite construction. And I think people underestimate. It's very difficult to frame up a structure in the middle of winter by hand, but for you to put up wall panels and trusses and sheet that roof on the nice days of the winter, that becomes a lot easier. So I think the technologies and the automations in construction have also helped us build in a more 360-day a year cycle.
Right. And I know Matt Lehman is online and just texted, this is the normal trend. And here's a seasonality. So this is the seasonality of lumber. You can see the red line is last year. The green line is this year so far. So we're almost $300 higher than we were a year ago.
Wow. And a year ago, few market participants believed that lumber was going to behave more like a cryptocurrency than a commodity.
Absolutely.
Greg, you got the Commitment of Traders report, right? I think there was an interesting move this last week. I'd
So
like to get Andy's take on that.
yeah, so let me. So here, Andy, this is CFTC report commitment of traders. This is the disaggregated. So this gives us swap dealers and managed money. Basically, segments out who's doing what here. And do you want to, Mike? What are you referring to?
Oh, maybe I was looking at the previous report, but
Let
essentially
me.
what we saw, managed money keeps getting longer.
Yeah, so this is you. Yeah, so December 31st, you saw that big increase in the
That's the one.
managed
Yeah,
money.
that's what I was looking
And
at.
so, Andy, you had asked what kind of fund participation you have. So you can see these are the percent of open interest by each category.
Yeah,
So the
managed
long
money.
funds, yeah, yeah,
Managed money, pretty big percentage, I mean, as a percentage basis. I mean, I know that open interest is very small, but listen, I guess it's some trend following systems that are in there, and God be with
yeah.
them. It's a rough, it's a wild ride.
Well,
Absolutely, the managed money component when it comes to lumber is usually momentum chasing. It's not
Yeah.
contrarian. They're not trying to pick tops and bottoms. They're trying to make tops, higher highs, higher lows. And so in this case, and I'll jump back to this week, but you had a slight build, but then you also had some shorts decreasing, some longs still increasing. That this is kind of your end of month position squaring, but you can see from a managed money standpoint, the fund longs are substantially greater than the fund shorts. And then when you look at the producer, and this typically, Andy, is going to be your mill shorts. This is going to be large industry type people, positions greater than 20 contracts. So you can see a slight build in commercial shorts. But when you compare this year over year, commercial shorts are sorry, let me jump back here. I hit the wrong button. Commercial shorts are substantially smaller year over year because last year, seeing prices go from $1,000 up to $1,700, everybody still has that fear of the what if scenario. What if lightning strikes twice? What if we repeat year over year? What if we do the same thing? So, that's part of the reason
Bro,
when it comes.
those margin calls were painful, no question.
Yeah.
So
So when you
yeah,
look at
that makes sense.
yeah, when you look at open interest, here's 2021 versus the previous years. You could see that open interest is substantially smaller. When you have the kind of volatility this market has witnessed over the last 12 to 18 months, you drive a lot of people away, whether it's commodity funds or commercial, because the volatility is the greatest thing when you're on the right side of it. When you're on the wrong side of it and you have to withstand the margin calls, you push people out. That in tandem with higher margin rates, higher price limits, it does a spectacular job in a boutique market like lumber of pushing people away.
Yeah. One of the things that I wanted to mention, just from my perspective, which is kind of, I'm not in the lumber business, I'm in the trading business and the investing business. Lumber is such an important bellwether for me. Because of the lack of liquidity in the lumber market over decades, I've watched lumber like a hawk, and I found that the lumber market tends to give me signals for other industrial commodities. And what lumber is telling me right now, and US energy policy is telling me the same thing, is that oil is going to make higher highs. Copper, because of decarbonization, is going to make higher highs. And industrial commodity prices are going higher. And lumber tends to move first. And the others tend to follow. So, and that happens in a lot of less than liquid markets, that they often send signals. So for me, lumber is a key bellwether.
Yeah, and I agree. So one of the big things that I think is interesting when it comes to lumber from a spread structure standpoint, and I'm going to jump back here, Mike, to the spreads
Yep.
and just quickly run through that. This is very interesting in that obviously I love spreads, but when you look at markets like copper, when you look at market like markets like energy, they're very bull market. There's a bull market structure in place from a spread standpoint that tells you that higher highs are ahead. When you look at lumber, it's very confusing year over year. This is the current January-March relationship, and we talked about this over the last month, how you've had this collapse of January carrying a big premium relative to March. This morning, the spread is now 20 under. And so in a market that's limit up, you have March and May doing the heavy lifting and January getting dragged behind. And so when I look at this versus a year ago, January, March went to 220 over. It settled at 130 over. So you have night and day. You've got completely opposite spread structure year over year. And so, I know that there's a segment of guys out there that think Jan, March could go back to 50 to 100 over. There's a segment of guys out there that think it could go 30, 50 plus under. So
Is
which is
that
it?
is that is that related to what you brought up before, the fact that last year was demand driven, this year is supply driven?
I think that you hit the nail on the head, that this is a supply constraint rally. This is not a demand driven rally. I know everybody can't get wood right now. There's all this demand. I think that's exactly it. I think
Yeah,
that this is some
listen.
more
In
some
the world of
supply.
commodities, when supplies are difficult, you get the wildest price swings. Demand is a difficult situation to get as an analyst. As someone who analyzes, like 30 different commodities all the time. It's very easy for me to get my hand on supplies. Demand is kind of ubiquitous. It's all over the place. It's interspersed. Supplies tend to be concentrated. So when you have supply issues, you tend to get really wild swings in prices.
And I think the demand right now, if we could build 2 million houses, we'd build 2 million
Yeah,
houses.
yeah.
And the reason we can't, aside from some supply issue, is labor.
Labor, exactly.
But labor
Well,
affects the
and
production of
I'm gonna,
something.
that's interesting you bring that up, and I'll jump. This came out today. Here's ISM Manufacturing PMI Index, and thanks to Alex at Stone for giving this to me. But you can see, you know, how here's current, supply. The idea that supply chain is improving for any industry, let alone lumber. No, it's not only not improving, it seems to be getting worse here. And you can just, this is just the last year where this speaks for itself. That is, this is what, when it comes to housing, when it comes to lumber, this is what we would like to do versus the reality of this is what we can do. And this is what we can do is completely driven by supply. And people have to remember that when you build a home, the framing lumber, when you look at lumber futures, this is just structural framing lumber. When you build a house, there are engineered wood panels, there's OSB, there's CDX sheeting, there's nails, there's electrical, there's plumbing. All of these segments that go into building a home are having supply driven issues, supply constraint, whether it's logistical issues, it's getting raw material. There's a bevy of issues influencing getting materials on the job site at the same time to complete a home. And that certainly doesn't seem to be improving. And so it goes back to, this is what we'd like to do in housing versus the reality of what we can do. And I think that's going to be the continued theme for 2022. Is
Right.
the best we can do is a 1.5 to 1.6 million housing starts until the numbers show otherwise.
And as Mike said, to get the labor force to actually hammer those nails in and put those boards up is becoming very challenging. COVID variants aside, a lot of people are wages are going to have to continue to go up to attract people back to the workforce. And, we just have a lack of a workforce in this country right now in the U.S.
So, one of the reasons that I wanted to bring you on, Andy, is our industry of lumber people. If everyone talks to each other, you kind of end up with a bit of the same thought process. One of the things that is always thrown around is, oh, the funds are in, the funds are out, and we have this. It's almost the boogeyman of the speculator on the outside. But I think it's important for the people in the industry, specifically the people watching this show, to understand what your thought process is when you analyze the lumber market. And I guess we've been touching on it, but specifically, what would the entry exit points be in a market like lumber for the outside speculator, fund manager?
Well, first thing I'll say is that, from a trader or an investor, a seasoned trader or an investor's perspective, lumber is a very challenging market because it's what we like to call a roach motel. If you're right, you can't get in, and if you're wrong, you can't get out. You can get in easily, you can't get out because the liquidity is tough. Because when it's rallying, there are no offers, and when it's diving, there are no bids, and it makes execution very difficult. Now, having said that, lumber is very similar to a lot of other markets in that bull markets tend to take prices to levels that are irrational, illogical, and unreasonable. And bear markets tend to do the same. They tend to extend. And when you couple that factor with a lack of liquidity, it exacerbates that price volatility. That's why we saw lumber go to 17, 11, 20, on the high print on the continuous contract in May 2021. And we saw it fall to 488, less than a third of the price in August. Irrational kind of moves. If I were in the lumber business or the home building business, I think, listen, the futures are an important tool. If I was a producer or a mill, I would be using the futures. But, I would have because of the illiquidity and because of the fact that price moves exacerbate, I would be very attentive to the potential for margin calls, because you never want to get forced out of a hedge position because of a margin call, because your broker, there's not enough cash in the account or something else. And that's where the disasters come for the industrial users. And these futures markets are really, especially the illiquid ones, they are most beneficial and very beneficial for industrial users. For the speculators, listen, they'll come and go. I think most of what Greg showed in the Commitment of Traders report shows that it's a large percentage of a very small open interest. And I totally agree. These are trend following market participants who will follow the trend higher until they get barbecued. And I would wonder, I'd love to see statistics on how many of those trend followers were long at 17, 11, 20, and the prices that they bailed out of their long positions, I would imagine they were less than $800 lower, only because they couldn't get out, back in that May through August period. So very, very dangerous and treacherous for a trader, but very useful for an industrial market participant.
No, and I think Matt mentioned, commercials are short and usually early to the party. So, and I think this is the critical part. As long as you have a risk management plan of why you're doing something, and you anticipate the ability to margin something and see it to fruition, it works every time. You might have to roll it two to three contracts. All I can tell you is that, and I don't have it in front of me, but statistically, commodity funds are very good at entering into a position. When it comes to a market like lumber, are equally disastrous in exiting a position. Commercials have the staying power. The funds come and go, and when they come, it's spectacular, and when they blow up, it's even more spectacular.
Right, and let me give another caution here, and that I've seen. Listen, I've done a lot of consulting with gold miners and with copper miners and with food manufacturers on the grain side. The one thing that you have to do as an industrial hedger is you have to remove all of your emotions and impulses, because when the price is going up, it's very, very tempting to say, let me lift this hedge here. Let me buy back this hedge, and because the trend is higher, and let me sell it at a higher price. And that's where I've seen disasters happen. remember, when you put on a hedge, the hedge is there until you make delivery.
No, I think
Don't walk those legs.
Yeah.
that's a great point. And the one thing I'll add to that is, I have an easier time convincing sawmills to hedge energies, propane, to hedge natural gas, to hedge. I actually have a sawmill right now that has a bigger crude oil position than lumber hedge position. Why? Because when they're hedging these other commodities, they're fixing their costs. They can fix their costs 12, 24 months out. When it comes
Right,
to lumber hedging, they're fixing their profitability. They're
right.
fixing a profit margin. When market exceeds their profit margin, there's always inevitably somebody that questions, well, wait a second, why are we hedged? We could have made this much more money. So that's why it's critical to have C-suite involvement, CFO involvement in understanding that this is a hedge. This is the reason you did it, and see it to fruition.
Right,
Absolutely.
and exactly, and it all comes down to putting your emotional impulses aside. Any seasoned trader will tell you that when they give in to their emotions, to the little voice in their head, that's where they get themselves into trouble. It's great to believe in your own business, but the survival of your business depends on producing a commodity at one price and selling it at a higher price, and not screwing around with the that equation.
So, Andy, you've been in the business for 41 years. Um, you worked for some infamous names on Wall Street, Solomon Brothers. You've traded many different commodities, both futures and physical. Um, what's different about the markets, and what's the same? Like in
Well,
looking
listen,
back on
it's
your,
a great question. So when I started, and I actually started as a summer mailroom employee in 1976, delivering telex messages, which were the precursor of emails, to traders and traffic people. And I used to read them when I was 16, 17 years old. And I learned the business from the ground up, from transporting commodities to trading them to running different businesses. But what was different back then was that price transparency was not the same. The copper producer in Chile didn't necessarily know what the consumer in China was paying for a ton of copper. And that went through all commodities: gold, silver, oil. The futures markets were in the very nascent stage. Price transparency wasn't good. And technology, when I started trading options in 1983, we were the only desk in our company, including accounting, that had a computer on our desks. So
huh,
all the stuff was done on handwritten spreadsheets. So you can imagine over our lifetimes how technology has changed, the commodities business and everything. And price transparency has been key. So that's really the big difference. What's the same is the cycles. The bottom line is that in commodities, they have always fallen to prices where producers cut back because they can't make money. Inventories start to decline. Everyone loves a bargain, so they come in and buy, consumers, and then they start to rise. And they rise to levels where producers step up production, you know, consumers back off, inventories start to build, and they fall. And that's what's very much the same. The great pricing cycles, they might go to different levels, and certainly inflation, I believe, over the coming years is going to make for higher lows and higher highs. But remember, production costs are going up too with commodity prices. Commodity prices don't operate in a vacuum. So the production cost, if you're a farmer today, cost a hell of a lot more to produce a bushel of soybeans or corn or wheat than it did a couple of years ago, because your energy costs are higher, your fertilizer costs are through the roof, your equipment costs are probably up 30%. So you have to get a lot more for those and for those bushels. And in lumber, it's the same thing. Your labor costs are higher, your acquisition costs are higher, your taxes are going to be higher. So that's all, goes into this supply and demand pricing dynamic. So the curve in prices is shifting up, and that's because of inflation. But the pricing cycles remain very much the same. And remember, as I said before, Prices tend to rise to irrational, illogical, and unreasonable levels during bull markets, and they fall to the same during bear markets. And commodities are much more volatile assets than stocks or bonds or currencies. So we should expect, maybe not cryptocurrencies, but that's a topic for a different session. But certainly we have to take that into account in this environment, and we have to adapt. So things are very different, Mike, but things are very much the same.
So I'm going to take the opportunity for a shameless plug for Materials Exchange. And you talked about the level of price transparency. In my opinion, hence the reason we have Materials Exchange, it's a good thing. It allows you to operate your business better. And the reality is it's there and it's not going anywhere. So you might as well get on board because your competition is going to be on board. Do you think that this level of technology and price transparency has been good for the overall industry?
Oh, yeah. I mean, it's made for much better liquidity. It's made it easier to operate businesses. Listen, hedging is a wonderful thing. Hedging is a tool that allows people to stay in business used properly. And most companies do use it properly. So I think that transparency, hedging, technology is a wonderful thing. Now, do I think that I want to live the rest of my life in the metaverse? I don't think so. I prefer reality. So where technology takes us from here, I have no idea. But, in my life, in my business career, technology has been nothing but a positive development.
Fantastic. So look, we're 40 minutes into this. Let's wrap this up. I can't thank you enough, Andy, for coming on board and meeting with us and sharing your words of wisdom. If people want to follow your articles, which I think are important to follow, not just in lumber, but in other commodities, because there's a silver lining to watching other markets and seeing how they operate and correlate, as Greg Kuda shows us, all the time. Lumber's always been called the professor of economics in the financial world because we lead. So where can we see the information you put out?
I write weekly for Seeking Alpha. I write daily for Bar Charts. I write a couple of times a week for investing.com. I'm a partner in Bubba Trading. And, I write pretty ubiquitous. I'm all over the place as far as my articles. I cover a wide range, everything from stocks and bonds to cryptos to lumber to gold to oil. Luckily the editors allow me to write what I see. So I'm always trying to be timely with my pieces. I have a whole bunch of quarterly reports out that I'm putting out the next week on Bar Chart. I encourage you to take a look at what happened over the past year because history always portends the future. And, feel free to comment on my pieces or to email me through those sites. And I'm always quick to answer questions.
Mike, and I just want to say I've read Andy's stuff weekly for the last 5+ years, and I might not always agree with him, but he's a phenomenal writer. He lays it out there. It's very analytical in his viewpoints, his thought process, and I highly recommend reading Andy, not just for lumber, but just for markets in general. He's a very interesting read that, at the end of the day, he's very accurate, and it's always a good read, Andy. So I appreciate
thank you, Greg. It's interesting. I'm glad you don't agree with me, and a lot of people don't agree with me, and that's what makes a market. I mean, listen, I am not right all the time. I never purport to be right all the time. I say it like I see it, and the difference in my trading is it's the discipline of risk and reward that, if I get it right 50% of the time, I'm making money in the year because, risk and reward is the way to go in the trading business.
So I'm not sure if I'm giving you a compliment or a criticism, but you wrote the book here, How to Make Money with Commodities, in 2013, I believe it was published.
Yeah, a while ago. And, what I really like about that book, what was fun, there's a lot of anecdotal stuff in that book about I traveled the world as a commodities trader, as a physical commodities trader. So I tell a lot of stories about the sugar market and various markets and some very high profile traders I worked with and some big deals I did. And it's an interesting read. Look, the bottom line is that the market is from 2013 to 2022, it's 9 years. Some of the stuff in the book is stale, but the stories are never stale.
So it ranks number 892 in commodity trading on Amazon.
It's going to
I
go
hope
up
that.
after today, so you're gonna sell some books. And Mike, I just want to, this is obviously your show, but I'd say at least on a quarterly basis, if Andy's interested in coming back, I'd love to just get at least a quarterly recap on his thoughts on lumber, housing, just his outside perspective. I think is huge for people within the
I
industry.
couldn't agree
Sure,
more.
that would be great.
All right, we'll put it on the calendar. Starting Q2 of 22. We'll have you back on, Andy.
Sounds great.
All
Thank
right.
you so much. I really appreciate the opportunity to chat with you both.
No
Thank you so
worries.
much.
All right, everyone, be safe out there. Any questions for the group here, you can send them to me or find us online, and we'll see you next Tuesday.
Happy New Year, everybody. Thank you.
Happy
Bye.
New Year.